My name is Farhan, and in this video, you will learn to prepare the statement of cash flows. This question has been taken from 2022 Paper 1 exam. Grussel PLC has provided statements of financial position for the last 2 years. These are both shown below. Now, the statement of financial position shows the assets, liabilities, and equity at a specific point in time. And here you will see that we have two statements prepared for the year ending 31 March 2021 and for the year ending 31 March 2022. Each of the statements shows the non-current assets, the current assets, equity, non-current liabilities, and current liabilities for each of the financial years. We also have some additional information given here. And then we are asked to prepare a reconciliation of operating profit to net cash flow from operating activities for the year ending 31 March 2022 and complying with IAS 7. So what we will do first is understand the additional information, starting with the point number 1. Taxation for the year was £6,534. This is what we refer to as the tax expense and is shown normally when you prepare in the income statement. That is where this amount should go. Then we have amounts for dividends that have been paid during the year, which is £24,000. We know that a second debenture was taken out on 1 November 2021. Now, debenture is a fancy word for long-term loans that our company has. Point number 4, a non-current asset which originally cost £62,000 with a net book value of £35,000 was sold for £39,500. So let's get into the workings straight away. So taking the last additional information that we have, which is point number 4, we know that the disposal proceeds is £39,500. The disposal proceeds is the amount that we get by selling the non-current asset that we have, which in this case is £39,500. We have been provided with the net book value and we have been provided with the original cost. Now, if you want to find the net book value for the asset or any asset, you start with the original cost and then you subtract the total provision for depreciation or the total accumulated depreciation that that asset would have. Now, the net book value is given to us as £35,000. The original cost is given to us as £62,000 for the asset that we have sold. So, logically speaking, the total provision for depreciation must be £27,000. So when we subtract that from the original cost of £62,000, we arrive at the net book value of £35,000. So this is one information that we will need later when we prepare the reconciliation. So we'll just skip it here for now. At the same time, we can also find the profit on disposal. Now, the profit on disposal can be simply calculated by subtracting the net book value from the disposal proceeds. So the disposal proceeds is $39,500 and the net book value is $35,000, which means that we have sold the asset for a higher price than what it was worth at the time, and we have made a profit of £4,500. So the key takeaways from point number 4 is that we have calculated the total provision for depreciation or the total accumulated depreciation, which is £27,000, and the profit on disposal, which is £4,500. And we will be using both of this information when we prepare the final reconciliation. Okay, so what's the next thing? So next, I have drawn a T account for retained earnings. And the main reason is, if you check the additional information number 2, dividends paid during the year were £24,000. Now, dividends are paid out of profits. So dividends are a share of profits that are given to the shareholders of the company. Now, retained earnings are the earnings that have been reinvested in the business. And these earnings are those ones that are left behind after the dividends are paid and then carried forward to our next financial year for reinvestment purposes. Now, if we go to the statement of financial positions that we have been provided, you will see that retained earnings for the year ending 31 March 2021 was $111,597, and for the year ending 31 March 2022, it was $122,030. Now, we are preparing the statement of cash flow for the year ending 31 March 2022. So whatever balances for retained earnings we had last year for 31 March 2021 would be an opening balance for this year, and the closing balance would be the balance that we are given here for 31 March 2022. So we have constructed a T account for retained earnings, which is also known as the ledger account. Now, retained earnings is an equity account. And why is this an equity account? Because as we have just discussed, retained earnings refer to reinvestment of profits from previous financial years after the dividends have been paid out to the shareholders. Okay, now retained earnings being an equity account should have an opening balance on the credit side always and a closing balance on the debit side. Again, based on the fundamental rules of accounting, all equity and all liabilities must have an opening balance on the credit side of the T account and a closing balance on the debit side of the T account. So make sure you remember that, because it's going to help you in getting full marks in the main exam. So starting with the opening balance, as you can see, I've written on the credit side. So this is what we call the credit side of a T account. Balance brought down is £111,597. And this is the amount that we have got from here, which is the information that we had for end of previous financial year. And the closing balance is the one that we have at end of current financial year, which is balance carried down of 122,030, taken from the second statement of financial position. Now, this retained earnings will go up in value, as we have said, when we have profits. The profit is the net profit here that we are referring to. So this is something that we haven't been given directly in the question. This is something that we will be calculating, but we do know the dividends based on the additional information that we were just discussing. Additional information number 2 clearly says that dividends paid during the year were £24,000. And like we have discussed a while ago, dividends are paid out of profits, which means dividend payout would result in a reduction in the balance for an equity account, or the reduction in the balance for retained earnings, and is therefore debited. So dividends of 24,000 is what we are showing on the debit side. Okay, so this is the information that we are looking for to calculate from this T account. So what we are doing here is finding the total of everything on the heavier side, which is the debit side in this case, and that is £146,030, which must be the total on the credit side to be relevant for the fundamental rules of accounting. And once we subtract the opening balance, or the balance brought down, of £111,597, we get £34,433, which is what we classify as the final profit for the year, or the net profit for the year. All right, so be careful. I've made some information here. I've written some information here that net profit, or the profit for the year, is calculated after the taxation and interest expense has been deducted. All right, but we are mainly interested in finding out the operating profit. So operating profit excludes the effect of taxation and interest, which means the net profit that we have just derived by constructing the T account for retained earnings, we will be adding back the taxes and interest to this net profit, and that's how you will arrive at the operating profit. Okay, taxation for the year was £6,534 based on the first additional information that we are given. As you can see, I'm circling on the left-hand side. So if you want to find the operating profit, we start with the net profit of £34,433 that we have just found out from the retained earnings calculation. Then we are adding the taxes of £6,534, and then we need to add interest. Now, the interest expense is something that we had to calculate separately, because again, you are in A levels and none of the information is given straightforward, and that is the part of the challenge for this exam. So interest expense is obviously calculated on the non-current liabilities, or the debts the business will have. So if you check the non-current liabilities section, you will see that we have 6% debenture. Now, the 6% here refers to the interest rate, all right? So debenture, as we have just discussed a while ago, is just a fancy word for long-term loans that a business has. You will see that at the end of the previous financial year, which is 31 March 2021, we had $70,000 worth of debentures in the books. And at the end of the current financial year, we have £90,000 worth of debentures in the books. All right. So what we're going to do first is calculate the interest expense on the first debenture that we had, which was £70,000, using the rate of 6% that's given here. So interest expense for the first debenture is 6% applied on £70,000, which gives us £4,200. All right. Now, this long-term loan of £70,000 from previous financial year is still in use within the business, and therefore that is the reason behind why we're applying 6% straight away and finding the annual interest expense for this first debenture of £4,200. Now, if you check the additional information, we have some extra information there for a second debenture. Point number 3. A second debenture was taken out on 1 November 2021. So it was taken at some point during the current financial year ending 31 March 2022, and therefore will not be expensed for interest purposes for the entire year, but for some months that this debenture was in use within the business. All right. So we want to find this value of the second debenture. So how do you find the value of the second debenture? You will see in the previous financial year, as we have already understood, that first debenture was worth £70,000. And we know that in the current financial year, we have taken a second debenture. And after we have taken that, we have total debentures of £90,000 within the business. This means that the new debenture that we have taken out on 1 November 2021 was worth £20,000, as you can see I have mentioned here. All right, so if I was to find the interest expense, because the 6% that's quoted in the question here is an annual rate, if I was to find the interest expense on the second debenture on an annual basis, I would just simply take 6% and multiply it on £20,000, and I would arrive at £1,200. All right, now monthly interest, if I was to derive the monthly interest, I would simply take the annual interest of £1,200 and then divide it by 12, which will give me a monthly interest of £100. Okay, we know the loan has been taken on 1 November 2021. And since 1 November 2021 until the end of 31 March 2022, which is the end of the current financial year for which we are preparing the statement of cash flow, how many months have passed? So we have November, we have December, we have January, February, and March. So that's 5 months in total. All right. So if the monthly interest is £100, then the interest for 5 months would be £100 multiplied by 5, and therefore would be £500. Does that make sense? So £500 is the relevant interest expense for the second debenture that we have taken out on 1 November 2021, and £4,200 is the interest expense for the first debenture that we already have in place since the previous financial year. So on that basis, the total interest expense for the year ending 31 March 2022 can be calculated by taking the interest expense from the first year of previous year of £4,200 plus an additional £500 relevant to the second debenture, and therefore we get a total interest expense of £4,700. Now, this is the amount that we will be adding as interest to our net profit along with the taxes, and then we'll be getting an operating profit of £45,667. Okay, so the question says, reconcile the operating profit to net cash flow from operating activities. So the first thing that we have just solved to put into our main answer is the profit from operations of £45,667, which was calculated after we found the net profit from the retained earnings T account. Then we have the taxation amount that's given to us in the additional information, and then we have derived the interest expense for 2 debentures, one from previous financial year that's been carried forward to this current financial year, and a new debenture that we have taken out in this financial year from 1 November 2021. Okay, so now that this is sorted, let's see what do we have next. All right, so once the profit from operations has been calculated, which is £45,667, we have to add back any non-cash income, subtract any non-cash income and add back any non-cash expense. All right. The main reason is we are preparing the net cash flow from operating activities. So we are mainly interested in items that have an impact in terms of cash inflows and outflows. So the profit from operations that we have, which is £45,667, this includes the effect of many non-cash items that we need to remove so that we can have a solid figure for that is only for cash purposes. Okay. Now the profit on disposal is a non-cash income, and this is what we have to subtract because, again, we are trying to arrive at cash from the profit from operations that we already had. So £4,500 is the profit on disposal, which we have derived at the very beginning, if you can see here. So profit on disposal on the right-hand side of the screen, you will see that we have found 4,500 by taking the disposal proceeds of 39,500 and subtracting the net book value of 35,000. Okay. So profit on disposal is a non-cash income which we have to subtract because this is income that is not based on cash. Then we have a non-cash expense, which is depreciation, and you'll see we are adding back this amount. Okay, 95,555. So where did we get this amount from? So let me show you. So I have prepared a ledger account or a T account for accumulated depreciation. And accumulated depreciation is a contra asset account. This contra asset account will always have an opening balance on the credit side, as you can see up down here, and will always have a closing balance on the debit side. Now, where did I get these balances from? So let's go to the statements of financial position. And in the non-current assets section, you will see that we have the accumulated depreciation given for 2 financial years. The previous financial year had an accumulated depreciation of 339,930, and the end of the current financial year has accumulated depreciation of 408,485. So again, the previous financial year accumulated depreciation will become the opening balance this year. So on the credit side, as you can see, I've mentioned balance brought down or balance BD of 339,930. And on the credit side, I've included balance carried down of 408,485. Okay. So this amount is something that we had to derive at the very end. So we'll come back to this. You'll see that on the debit side, I've included a disposal of £27,000. Can you guess where this came from? If you got that correct, this came from the disposal based on the additional information number 4 here that we have calculated a while ago. So if we move back to our workings there, you will see that I told you that I'll be coming back to this eventually. And we found the total depreciation for the asset that we have sold of £27,000 based on the net book value and the original cost that we already knew. So this is what we have derived, and this is what will need to go into the accumulated depreciation T account. So why is this on the debit side though? Because this is an asset that we are getting rid of from the books. So if accumulated depreciation by default has an opening balance on the credit side, anything that reduces this accumulated depreciation will be need to shown on the debit side. So the disposal of £27,000 is what we have shown on the debit side for the asset that we have sold. And then we have to balance this account and arrive at the amount for depreciation expense. So the heaviest side is the debit side, and we have found the total of £435,485, which must be the total on the credit side to be balanced based on the fundamental rules of accounting. From this £435,485, we have subtracted the opening balance of £339,930, and the amount that we got is £95,555. And you can see that I've mentioned that this amount is what needs to go in the income statement. In the income statement, we always show the depreciation expense that we have incurred for the year. And in the balance sheet, we show the accumulated depreciation, the total depreciation since the beginning of the usage for the assets that were purchased. So as you can see, this amount, 95,555, I've mentioned here, relates to depreciation expense for the year. Now, depreciation expense is a non-cash expense. And the profit from operations that we have already has the effect of depreciation included within. So because depreciation expense is a non-cash expense, we have to reverse this from the profit from operations. And what we have to do in this case is add that back. So as you can see, I've mentioned depreciation of 95,555 here. Again, just to keep things simple, you start with the profit from operations and you always subtract any non-cash income and you add back any non-cash expense, which in our case is depreciation. Okay. Then we have some simple calculations with regards to changes that we have experienced in the current assets from the last year to this one and current liabilities. So let's have a look into all those. So if you go to the current assets section, you have inventory and you have trade receivables. We don't care about cash and cash equivalents because when you prepare a statement of cash flow fully, the cash and cash equivalents that we have here at the end of the current financial year must be the ending balance from that statement of cash flow, given that you have prepared it fully. So we do not take cash into account because we are actually trying to figure out if our math is correct based on this cash and cash equivalent balance that we're given in the balance sheet. But then again, that is not a requirement in this question. Okay, so inventory at the end of the previous year had a balance of £38,567, and at the end of the current financial year has a balance of £36,345. This reflects a reduction from one year to the next. As you can see, I've mentioned a decrease. And what's the exact amount of this decrease? So you take your calculator, you find the difference. So 38,567 minus 36,345, and the difference is 2,222. So inventory has decreased by 2,222 compared to previous financial year. And you can see I've explicitly mentioned here decrease in inventory of 2,222. And you can see this is something that's being added here. Now, logically speaking, why is it that we're adding this amount here? Now, think about it. Inventory can only decrease in the sense that you've actually sold those inventories. And if you have sold those inventories, there is this cash inflow. So that is the basis of why we're adding this. So you will see that within the statements, apart from the non-cash items, if you have a cash outflow, you'll be subtracting those. And if you have something that is signaling a cash inflow, you'll be adding that. All right, so let's check the next one. So the trade receivables under current assets have increased from the previous financial year. As you can see, in the current financial year, we have £27,234. And in the previous financial year, we had £25,346. This means that compared to the previous year, trade receivables have increased. And the amount of increase is simply the difference between 27,234 and 25,346, which is 1,888. Now, if there is an increase in trade receivables, this refers to the fact that you have got less cash, because increase in trade receivables simply means that you have made more credit sales, which would obviously reflect less cash coming into the business. And that is why you are subtracting that. So increase in receivables, 1,888. So you can choose to memorize how you're going to prepare the statement of cash flow, but it is best to exercise logic and then use it as a basis to know when to subtract and when to add. Okay. Then we have decrease in payables. So this is obviously referring to the current liabilities. So let's move into the current liabilities section. So in the current liabilities section, we have the trade payables. So in the previous financial year, trade payables had an amount of 17,486, which decreased to 14,064 for the current financial year. And the amount of decrease is 3,422. So decrease in trade payables is 3,422, and you can see this is within brackets reflecting a cash outflow. Why is this a cash outflow? Because payables are those people to whom the business owes money. And if there has been a reduction in these payables, that should obviously reflect the fact that you have paid some of these payables, if that makes sense. So because you have paid these people, this means that you have paid them using the cash that you had, and this should obviously reflect a reduction in the cash that you have, and that's why it's in brackets reflecting a cash outflow. All right, so once you have found all this, so then you just simply take care of all the calculations here, and you should arrive at the cash from operations of £133,634. Just to give you a quick recap, once you have derived the profit from operations, you subtract any non-cash income, then you add back any non-cash expense, then you take care of your current assets and current liabilities, and then you should arrive at cash from operations. Okay. Now you see, under the current liabilities, we also had tax payable, but we didn't include it with our calculation for cash from operations. Why? Because cash from operations, again, excludes the effect of taxes and interest. So taxes and interest are what we will be showing separately, because that is when we are complying with the format prescribed by IAS 7. Okay, so so let's find the amount for interest paid. I think we have already derived it, which is £4,700, and it's in negative. And why it's in negative, it is very clear because it's an outflow. You are paying interest using the cash you have. So where did we get this £4,700 from? If you clearly remember, we did this calculation earlier. So for the first debenture, we had interest expense of £4,200. And for the second debenture, which was taken on 1 November 2021, we had a 5-month interest expense accrued of £500. That gives us a total interest expense of £4,200 plus £500 of £4,700, and that is what we have shown here. Okay. So now we take care of the tax paid. So how do we find it? So again, I've created a T account or a ledger account for tax payable. Now, tax payable is a current liability account, obviously, because it's payable, taxes that you accrue to the government. And tax payable, because it's a liability account, where should this have its opening balance? On the credit side. All liabilities have its opening balance on the credit side, and all liabilities must have their closing balance on the debit side. So the opening balance of £1,800 is on the credit side, as you can see. And where did I get this £1,800 from? It's mentioned here. So tax payable. So £1,800 was the balance we had at end of previous financial year, which becomes the opening balance for the current financial year. And then for the current financial year, which is the closing balance for the year ending 31 March 2022, we have £2,500 as the balance carried down. Okay. So what about this amount? This amount is something that's been given to us in the additional information. It clearly mentions that taxation for the year was £6,534, and taxation for the year of £6,534, in other words, refers to the tax expense for the year, which is what we show in our calculation for profit in the income statement. So that is something that we already know. So the amount that has been actually paid for tax, which obviously has been paid for using cash, is something that we had to derive ourselves. So what we did was first found the total on the heaviest side, which was to add everything on the credit side, add the opening balance of £1,800 with the expense of £6,534 that's given to us for the year, and we arrive at £8,334, which must be the balance on the debit side as well. And from there, you subtract the closing balance that we already know of, and the amount that you're left behind is the amount that you have actually paid for in tax using your cash. So £5,834 is what we have paid for in tax using our cash. And that is what is going here. Again, logically speaking, this is negative because it refers to an outflow. And once you have done that, you can subtract the interest paid and the tax paid from the cash flow from operations, and you should be arriving at net cash flow from operating activities of £123,100.